We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance.
Today, if you're using M1 Finance, I think you're doing some things wrong, and I want to break that down for you, so let's jump right into this. Welcome back, passive income investors alike. Today, I'm talking about something I don't even use M1 Finance, but I watch a lot of you. A lot of you love it. A lot of you use things like Robinhood. You love those little pie charts and diversifying the heck out of your portfolios. But here's what I want to tell you today, guys. The things that I noticed that you're doing wrong, especially if you're using M1 Finance, and just some of the implications I don't think you're really fully aware of, because either your account's too small or you just really have no idea what you're doing. And I don't want to put it up myself on a pedestal here like I'm some smart investor. I've only been doing this for about 6 years, and I know a lot of older investors, like, you can't take advice from a 20-year-old about stocks or anything like that. It's really hard to talk to a 20-year-old about investments. But, I built a six-figure account. I know some stuff, and I think I can help you guys out. So let's just jump right into this, guys. And I really want to start with that first thing that I just mentioned, which is you're just too small. And what do I mean by that? When I started investing, guys, I had $500, just like a lot of you. But the difference that I've noticed between me and a lot of other people is that there's two routes you can kind of go in investing, okay? You can go diversified, broader markets, etc., or you can go pinpoint, precise, individual stocks, companies you love, breathe, and want to own. Those are the only two directions you can go in. And a lot of you will take $500 and you'll buy like 15, 20, even sometimes 30 stocks, putting like $2 into a stock. And you're not, I've been trying to explain this because I watch some guys that can't handle the volatility. I've watched a lot of people go in with $500 to buy like 10 different companies, Amazon, Facebook, Apple, all these different companies, guys. They'll see like this little bit of growth in their account and they'll be so giddy. They'll be like, oh, I just made like 5-10%. Oh my goodness. On $500, you made like $5. Whoop-de-doo, guys. And I'm not trying to be rude about that. It is an incredible thing. The reason I'm battering you about this is because you're not a financial advisor. You're not, like, do you know how complicated the Vanguard 500 index fund is? Like, the way the system's inclined to manage trillions of dollars. Like, it is a substantial thing, and it's been around for a while, and it's like a proven track record. But a lot of people are coming in with absolutely no money, trying to manage an ETF like they know what they're doing to make absolutely no money. And it blows my mind. Now, Uncle C, guys, I don't know if you know Grant Cardone, the good old Uncle C, the real estate mogul.
I shifted your mind by giving you a target.
Always goes on about, don't even waste your time looking at anything until you have 100 grand. Go out, make 100 grand first, and then find somewhere to put it. Because the problem is with you small guys is you need the volatility on your side. When you're small, when I first started investing, I owned 2 stocks. In fact, if I put all of my money in those 2 stocks, I'd probably be worth about $500,000 today if I just did that. Because the companies I were buying, I really overanalyzed. I did a good job, and I bought them, and that was my entire focus of all the stocks out there, of all the companies that exist, guys. Microsoft, Amazon, though I wasn't buying any of them. The 2 companies I was buying 5 years ago, you probably didn't even know their names. Northland Power and Canopy Growth Corp. 5 years ago, these companies, to most people, were completely non-existent, guys. Those were the companies that I was investing in, and I did quite well. I buy individual stocks because I love individual stocks. I love understanding them. But I've come to realize that a lot of you overtrade these things. You don't understand them well enough to be holding them. You're not listening to the conference calls. You're not going over their annual reports. You're not looking at you're not doing really anything. You're just buying them because you hear about them and you like them and maybe use an iPhone. That's why you're buying Apple. You don't actually understand how much money they make. You don't understand how they use their money. You don't understand share buybacks. You don't really understand what you're doing. And in my opinion, if that's the route you're going to go down, you're better off just buying a Vanguard 500 index fund, guys. Just save up $200 or $300 and buy that. You can walk away from M1 Finance at that point and never look at it again, and just funnel all of your money into that one index. It's great management. It's the lowest fees in the entire world, and it is the benchmark for every financial advisor in history, guys. So don't over diversify yourselves in the beginning. It's absolutely absurd. Honestly, you guys need one stock. You need an Amazon. You need to find a company that is volatile, that you think has growth. So when you put $500 into it, a year from now, it could double, it could triple. In just 5 years, it could quadruple, like Canopy did for me, guys. You'll find that one company you'll load up on, and it'll be what launches your account. In the beginning, that is what you need. Even Warren Buffett, the Buffett himself, guys, the Warren Buffett, the Charlie Munger, all agree that you can be diversified enough just buying a couple local businesses. You could save up a few $100,000 and you could buy something not even in the stock market, guys. You could buy something like off, Empire Flippers. You could buy online businesses. You can buy something that's functioning already, and it can make you enough income to survive the rest of your life. That is diversified enough. But when you go to your job, because you make a stable payment, like you literally you get a stable payment from a business, you think that that's stable, that's concrete, that's level, but you forget about inflation, the volatility of the dollar. All of that stuff is volatile. So I found way too many of you guys are getting worked up about individual stocks moving up and down in crazy directions like Tesla. That is actually your best friend in the stock market in the early days. You need those kind of volatile stocks to give you the options to get in at the right time to grow your account quicker. Now, again, guys, like Warren Buffett and Charlie Munger, they always go on about how simple you could be just buying a handful of businesses. Those guys are billionaires, and they own such a small amount of companies, guys, like a handful of companies. And there's all these people telling me that I need to be buying ETFs. Why would you pick individual stocks? Most people can't play or do it well or whatever, and it's fine. I just don't enjoy it. In my mind, it's just I want to see a good business. I understand. I actually feel good owning it, and the more I own of it, the better I feel. I get payments. I own enough of it. Usually I try and get around $10,000 in each individual investment at the minimum, so that way I'm actually collecting a decent yield off these companies, and I start with one, and then I look at a couple other. I usually look at an individual sector. I'll pick usually 3 companies within a sector, usually 2 dividend yielding and 1 higher growth, and I'll leverage my money in between. I'll start by buying a few thousand of each one, and then over time I'll just kind of grow them until I get to a position where I'm comfortable, and then I move on. And move on to the next one. I'm done with those one, guys. Next. And that's just how I do it. But I'm not sitting there being like, I like Facebook, I like Amazon, I like this, I like that, I like that, I like that. They look cool. They're shiny little objects. Let me just load these all up. They're all little shiny cool objects. Let me put them in my portfolios. Let me put all these in my portfolio and show YouTube friends, because YouTube pays AdSense money. I get paid from just adding all these and showing people onto YouTube. It seems to be what the world of M1 Finance has become lately, guys. Now, tax implications is another thing. Those of you guys that don't realize that when you're trading stocks, usually I don't think M1 Finance actually gives you, I don't know if they actually do your tax platforms at the end of the year. Bank of Nova Scotia, Scotia iTrade, the accounts that I'm using actually provide you with your tax returns at the end of the year. They actually make doing taxes somewhat easy, as long as you're staying away from companies like LLCs and certain things that change the way the taxes get done. Because you got to remember, you're buying shares in a company, guys, so depending on how these companies are structured will also depend on your the way you're going to have to deal with your dividends payout, the way you're going to have to deal with capital gains and capital losses. M1 Finance, from my understanding, is a huge tax complicator from what I've heard. Don't quote me on that. I just understand the more trading you're doing in M1 Finance, the more complicated your taxes are going to become at the end of the year. Just something that a lot of investors just overlook right away. They don't think about it. Sure, you're getting the commission free, things like that. But as soon as you start trading, you really got to start paying attention to what you're going to do, because you might be giving yourself some extra costs just for the time it's going to take to figure that out. So again, it comes back to being small, guys. It's really hard to invest with small money unless you're really picking higher risk companies that you understand. I'm just saying that in the beginning, guys, it's tough. It's just how investing is. In the beginning, until you got money, you got to find a job, you got to work hard and stuff, all right? So stupidity costs, especially in the beginning. But the big thing, though, is in the beginning, guys, is that in the beginning, though, the stupidity costs, it costs not a lot. That's why you want to make riskier positions in the small days, guys. In perspective, guys, when you start understanding and you start building out your portfolio, losing $2,500 is not the end of the world. I've lost more than that. Luckily, I don't think I've actually taken a loss that big on any individual trade personally, but over time I've lost substantial amounts. But again, 2,500 is nothing, guys. In the perspective of things, when you grow your account to 100,000 to 500,000, by the time you're 40, 50, 60 years old, and maybe you're even managing $1 million, you're not going to be making those stupid mistakes that might cost you 40, 50, 60% of your portfolio at the time. But it's good to do it early on. And then on top of that, anything that you're taking high risk might give you the opposite end of the stick, guys, like Bitcoin, where it could just explode. Not that I'm advising you to buy Bitcoin or anything of that nature, obviously, guys, but you're better off taking on the higher risk when you're younger. Get used to the volatility while you're younger, because that's how the world works. There is nothing stable in the world, not even your bloody paycheck from a job. So don't get in that mindset that you think volatility is scary watching these numbers move, because you need those numbers to move. Sure, they might move down, but when you catch the right drift, you're going to move all the way up with it, and you're going to be able to grow that account right away, guys. So you got to learn. So you got to simply just learn to enjoy the volatility while you're in the early stages of your portfolio, guys, because you do not want to enjoy this as much later in your portfolio. But trust me, you're going to get used to it. As I've said, if you've watched these videos, literally in the last 2 weeks, I have watched my account move $5,000 to $10,000 in each direction. I mean, that's half of what some people make in a year. Literally, my account's just like waving up and down. But again, guys, I've gotten so adjusted to the way the markets work. It doesn't bother me because I understand the companies I'm buying. I've done my research. I've done my due diligence. I have spent years building out positions in these companies, watching how they move over time, buying the dips, buying when it's too expensive. Like, it's all a learning curve. But as you buy over time, you get more and more comfortable with exactly how this works, and you can use it to your advantage because you'll start sensing when the market is taking what I call breaths. Money will flow in like a breath and flow out like a breath, guys. It comes in these cyclical waves. I'm not sure what causes it, but it's like the tides that the moon causes. It's just like the weather goes from hot to cold. Like, it's the natural order of things. It's a weird fluctuation from good to bad. It's just the way nature works, and I think it's perfectly resembled in the stock market, considering the stock market represents the entire economy and us as human beings and as nature as a whole. And I want you guys to let me know in the comment section below, are you using M1 Finance? What's your personal experience with it? And maybe you think I'm wrong. Maybe you think over diversifying and the way M1 works is actually better for you, and being able to buy fractional shares. So instead of just saving up and buying one share in Apple, you think you're better off buying an eighth of a share. I don't know why you would think that, but a lot of people seem to enjoy it. So I think it's a little nutty, to be honest. But you're talking to a guy that only holds literally a dozen positions. I don't hold a lot of stocks. In fact, I don't hold most stocks that people hold in M1 Finance. There's just a lot of companies, like, people just love holding Facebook, Apple, Micro. It's just weird to me. As I scroll through YouTube and I watch these M1 Finance videos, I always find someone that'll open up a portfolio. I'll see something like $800 in it, divided out between like the top 10, 20, even 30 companies that we all know of, Netflix. And I just don't get it. I'm like, do you even understand what you're buying? Because if you don't, why are you managing it? Because if you don't understand what you're buying, first of all, you shouldn't be trying to manage it like an ETF or mutual fund. You should be giving it to somebody else to be managing, and you should just step aside and go focus on something that's going to make you real money, like your job, the business, or just something out in the real world that isn't stocks. Stocks are not for everybody, but they are for me, and if you're watching this video, it might be for you. So consider stopping a like, guys. Stay cool, stay awesome. I hope you enjoyed this quick video today, and I look forward to chatting to you real soon.